going on YouTube? We have Triple M or 3M Company in this video. We're going to go through their most recent financial report and go through their earnings a little bit. They just reported their earnings late last week, January 23rd, beat on top and bottom line and gave us some guidance. And you can see right here, based on that guidance, it probably wasn't that great. And because analysts, 10 of the 15 analysts have revised their expectations lower next quarter. And also, we can see in the stock chart, stock went from about $108 per share down to $96 per share. So about a $12 hit to the overall stock price. And then that puts them year to date down about 12%. So in their earnings call, they gave us a little bit of some guidance here. They're going to be doing some pre-tax restructuring in the range of 250 million to 350 million, and that should save them about 150 to 250 million dollars. And so that should also get carried over to their margins. Their margins should get a little bit better than where they are now. They gave guidance on EPS in the range of $9.35 to $9.75 per share. And that was a little bit of a reduction to their guidance and what analysts had expectations of. So that right there is basically why we're seeing a sell-off in the share price right now. So now over to the financial spreadsheet here. We're going to run through the charts and see how this thing is performing and trending over time. We got a revenue, gross profit, and net income. Both revenue and gross profit are relatively stable, a little bit flat, kind of declining at the moment, but it's kind of like a very shallow wave of volatility here. But we can definitely see our net incomes went from, well, we can see them over here, 5.7 down to negative $7 billion. But the reason for that, though, is we can see that their SG&A cost over here was $9 billion, trailing 12 months, $21.5 billion. When you have a lawsuit, that gets calculated or that gets placed into your SG&A cost, which is why we see a $12.5 billion increase to our SG&A. So this most recent report does not have any of those those lawsuit costs involved or included in the SG&A. So we can get an understanding now, see where numbers are going to be going and potentially trending going forward, which is why their EPS is currently negative, but they're forecasting $9 per share of EPS. That's why there's, because they don't have this impacting their overall net income. That obviously is where their earnings per share comes from. So you can see our gross margins historically have been about 48-50% range. Last quarter, 41.6%. So margins still on the gross margins are still continuing to shrink. Net margins over here, we are getting our net margins back based on last quarter. We did 11.8%. And we'd really like to see this get back up into like the 16% range where it historically sits. So they got about another 5% of margins to get back right there. So let me come down here. Let's take a look at the cash to short-term debt. So company did not yet pay for these litigation costs that they had. And we can see all these litigations got put into liabilities for the time being. And we can see our short-term liabilities went from 9.5 billion up to 15.3 billion. And then our total liabilities that the company had went from $32 billion up to basically $46 billion. So significant increase to our liabilities. Not ideal, especially since you see the cash position compared to liabilities. These are just short-term liabilities, not including total liabilities. But the cash position here, we're sitting at $6 billion and total liabilities. Company's got $46 billion in total liabilities. So you come over here to net income to free cash flow. So because they have not paid out these liabilities, we see the impact to the net income. However, our free cash flows did not get impacted whatsoever. It's because this cash did not yet leave the business. So it just got placed under liabilities. They do have to pay it in the future, but the cash itself has not yet left the business. So that's why we still see cash flows are okay for the time being until they got to start paying down those liabilities, those litigation costs, I should say. But for now, we're still sitting at about $5+ billion in free cash flow. Capital expenditures have contracted a little bit to $1.2 billion. That is the lowest level we've seen in the last 10 years, so that's good. Our dividend, though, we can see has leveled off, and we does not appear we've seen any sort of dividend increase. Actually, we have very slight dividend increases over the last few years. Looks like 4% or 4 cents and then another 4 cents there. So very minor dividend increases over the last couple of years there. And our share count dilution is still getting bought back. However, because of the most recent increase to the debts, I cannot imagine they're going to continue buying back shares. And we can come up here. They don't even really pay, they haven't even paid out stock-based compensation last quarter, so that's good. And their stock-based compensation payout in general is actually pretty nominal. Then we come down here to common stock repurchased. So they have not repurchased any stock. They have issued stock last year, but they have not repurchased any stock either. So I would not expect them to buy back more stock, and also would not expect them to. I do expect them to potentially pay out stock-based compensation and issue more stock in the future, probably to cover some of these costs here. That would be my assumption, but we'll have to wait and see what the company does in the coming months, years ahead. Now over to our 10K. On their most recent report, we can see in the last 3 months, company did net sales, similar net sales year over year, and we come over here to trailing 12 months, down slightly on the net sales by about $1.6 billion. And we come down here, we can see in our SG&A column, $9 billion to $21.5 billion in SG&A. So that's their lawsuit, where their lawsuit got placed for, the cost of it anyway. But we can see here year over year on in the last 3 months, though, that the lawsuit does not appear to be in our current report. And we see $500 million reduction overall to SG&A. So that's even better yet. So that will then carry down to our operating income. We can see it's about $600 million difference there. We come down here to net income and about $400 million increase there as well. So our net incomes have come back, and now instead of being negative $7 billion, we're positive, $947 million in the last quarter. So we come down here to their balance sheet. Company's got $5.9 billion in cash. We can see year over year, it is up about $2.3 billion. So we want to maybe know where that $2.3 billion did come from. So we're going to want to keep that in the back of our mind as we go through to the cash flows and see where that money came from. So we come down here to our debts. We got short-term borrowings. A current portion of long-term debt did jump up about $1 billion. Some of that could have carried, which we can see $1 billion roughly of that did get carried from long-term to short-term. So that's no big deal there. And then we come over here to total current liabilities. Then goes from, we can see the big increases right there in other current liabilities. So that's stuff that's going to have to get paid this year in the next 12 months of probably litigation related costs there. But we can see the majority increase here, minus off $1 billion there. We got a good $4 billion increase right there on our overall other current liabilities. And then the rest of it has been categorized under long-term debt, other liabilities as well. We can see it's about a $9 billion increase right there. So big jump overall in our total liabilities, all because of those lawsuits. So then we come down to our cash flows here, and we do not have a full breakdown of the cash flows. I would really like to see that maybe once we get the 10Q, which has yet to come out. So we'll have to wait and see once we get that, how those look. So we got our cash provided by operating activities of about $6.7 billion. This time last year, we did about 6.6 or 5.6 billion. Our capital expenditures did shrink year over year. Again, we already saw that, which is really good to see that they're shrinking their capital expenditures, increasing their cash flows. So that leaves them with $5 billion in total free cash flow. You minus off your dividend here. You have $5 billion of free cash flow minus $3.3 billion of a dividend payout. You got $1.7 billion of debt or of cash left over. So that's about a 66% payout ratio currently. So would not expect any increases to the dividend currently. I don't think the dividend is currently at risk yet either. I think it's really going to depend on how these liabilities get paid out, if the company's going to borrow money or what its plan is exactly. But obviously, these liabilities are going to need to get paid, and they do have a good portion of them to pay yet this year. So we'll have to wait and see exactly what they're going to do with that. But in my opinion, the dividend does not appear to be at risk at the moment. Payout ratio is acceptable. And then obviously everything seems to be settled. Fire seems to be put out. So hopefully everything can get back into check and normal at this business. But we can see after that, after you get that paid off, we are still left with $2.3 billion roughly in excess cash. So we get to add that to our overall balance sheet. So that's where that $2.3 billion did come from. So it wasn't anything out of the norm there for our balance sheet increase. So now over to the calculator. So company currently is a negative EPS. So this EPS is forward-looking numbers, and PE ratio also forward-looking. And I pulled those two numbers in from Seeking Alpha right here. So with those numbers plugged in and an EPS growth rate over the next 3 years of 7%, we get a period fair value of $69.59. A manual PE is about 14 years to earn its current market cap, so it's actually really well valued. And then we got a price to book though. 5-year average is 6, currently sitting at 11 because of the huge increase to their liabilities. That's why that's so high. And then we got Graham's valuation, giving them, it seems a bit high to me, but $203.83 per share. And then we got dividend discount model, giving them $97.52 per share. Over here to our discounted cash flow. So if the company is, so historically, the company's done 4.8% growth on free cash flow. If they can do that, I gave them 4%, which I think they might be able to do because they are, they're going to restructure the business, right? They're going to save themselves 150, $250 million. So that'll help. And then they'll probably do some other things. Maybe revenues will start picking back up a little bit as well. So I think there's a possibility we could see a slight increase to free cash flow. So I give them 4% increase. With that, that gives them a DCF price per share of $280.95. And down to Rule 72, we have 3 sources of EPS growth rate for an average of 4%. That gives us the ability to double our current EPS about half a time. So that roughly gives us 14 for our future EPS, which is a fair value of $28.44 on this one. So overall, for an average summary of all the valuations we went over, we get a fair market value of $136.07. 30% margin safety is $95, basically trading slightly above that. Analysts have a price target of $115.67. And just side note, we have valued this company before, and when we did value it, we got a valuation of $70 per share, as we can see right here. And with that valuation, we were utilizing the numbers from the lawsuit. So it's really impacting their total EPS and growth rate. And because of that, that's why you see such a small valuation on that company. Because if things weren't going to turn around, worst case scenario was $70 per share roughly. And since things have, the fire has settled, now we got a clear picture, a much more clear picture of where things are headed. We've got some guidance and everything like that. Those lawsuits are behind us. Now we know where EPS is going to be. We know the outcome of everything at the moment. So obviously anything can change, but that's why this is so much different from the last time that we valued. Now we actually have forward guidance. We actually have to use forward-looking numbers in this instance as well, because obviously the company is still a negative EPS for the time being. Now over to the stock chart, we can see this orange line. We are locked in a downtrend from basically middle to early 2021 and just has been locked in this downtrend ever since. And finally, as of about middle of December here, we broke through the channel, this line, this downtrend, made a new, well, probably an equal high here. I wouldn't call that a new high. But did double test the high, pulled back on earnings here, retesting double support, this purple line and this orange line as a support convergence here. I could foresee this thing pulling back, probably resting here, obviously, and then would not be surprised if this thing can hold this purple line. Maybe has to back test this orange line, maybe retest the lows again, and then finds its way back higher. It could do a double bottom retest and find its way back up higher, but it has since broken trend and is now potentially back testing this orange line. Might break this purple line. It's not major support, but it is support. So this, to me, I would foresee this thing potentially doing a double bottom retest at $84 per share. It could pivot right here as well and continue and find its way back up higher. And if it does do that, I think the trend is over and we are now finally going to potentially see this thing make higher highs and higher lows, and it probably might get back up to $130 to $140 per share range in this ballpark there. So that is it for Triple M. If you found value in this video, drop a like, subscribe, comment, and back later with another stock analysis video.